Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. Today's question comes from Sid. Alan, please help. I wrongly speculated that Westmoreland Coal, ticker WLB, would flourish with Trump in office. I bought it for $18.14 in December, and it has tanked to $9.71 today, early May. Can I sell covered calls to get my money back? I will need downside protection in case it bombs further. I need to make something on this investment. Am I on the right track? I appreciate any advice, and it's signed Sid. Well, Sid, welcome to the club. We've all experienced stocks that we purchased which we anticipated going up in value and ended up heading in the other direction. So the question becomes, what do we do now that we're here? And we need to have a plan in place before we actually purchase that stock. And so let's evaluate your trade and see if we can come to some kind of conclusions how to mitigate situations just like these, which really everybody has experienced at one time or another. To get started, let's review Sid's trade. In December of 2016, Sid purchased WLB at $18.14. In early May of 2017, the stock was trading at $9.71, which represented a 46% unrealized loss. Sid's plan was to sell in-the-money strikes to generate both time value premium and downside protection. Now, having a look at the options chain at this point in time, we would see that the time value premium in the money strikes return for WLB was about 3.5% per month. And in order to recoup a 46 or 47% share value loss, it would take approximately 13 months to do so. So that's something we have to keep in mind before we move forward with this particular strategy. Let's first have a look at the price chart of WLB in early May to see if this is in fact a security that we want to continue keeping in our portfolio. So in the screenshot, we see the technical parameters that we use in the BCI methodology. So let's have a look top to bottom. The top section represents the 20-day and 100-day exponential moving averages, and you can see on the right side of the screenshot that the arrow shows a dramatic downtrend with price bars below the exponential moving averages, a very bearish trend identifying signal. The second arrow from the top represents the MACD histogram, which is both a trend identifying and momentum identifying indicator. We can see that too is bearish, having dropped below zero and trending in a downward direction. The third arrow from the top is the stochastic oscillator, which is a momentum indicator, and that has dropped from the beginning of April above the 80th percentile to early May, where it's below the 20th percentile, trending down, another very bearish signal. And at the very bottom, we've circled the volume, which is still very strong, confirming all the other bearish technical indicators. Kind of an ugly technical chart pattern here. So generally speaking, this is usually a stock that we don't want to hitch our wagon to and keep in our portfolio. However, we're going to have a look at the options chain, and we're going to take a look at these in-the-money strikes that Sid was considering. And then we're also going to have a look at an out-of-the-money strike had we found another security of equal volatility to see what we might be able to do selling out-of-the-money strikes. All right, so here's an options chain. We're going to look at the in-the-money $9 strike and the out-of-the-money $11 strike. So if we found another security like WLB in terms of similar implied volatilities, let's compare the kind of returns we can get. Now, the in-the-money strike generated a premium of $1.20, and the out-of-the-money strike, $11 strike, generated time value of 35 cents per share. All right. Now, we're going to take this information and feed it into the multiple tab of the Ellman Calculator, and we fill in the blue cells with the options chain information. And we can see on the top row that the in-the-money $9 strike generated a time value return, or ROE, of 5.4%. There is no upside potential because we've agreed to sell the shares at a price lower than current market value. However, we do have that downside protection that Sid was looking for, because he was concerned that share value could decline even further, and that's a very significant 7.3%. Remember, these are 6-week returns now. However, if we found another security with similar volatility, the out-of-the-money $11 strike generated a time value profit of 3.6%. Now, if share price moved from current market value up to the strike, it would give us an opportunity for an additional 13.3%. So in this particular case, we have an opportunity for a 6-week return of 16.9%, almost 17%, which means that we could mitigate our 46 or 47% share value loss in under 3 months using out-of-the-money strikes if everything fell into place. The possibility and potential is much greater with the out-of-the-money strikes. So that said, let's kind of review and summarize and evaluate what we do in situations like what Sid has here with WLB. To recover a 47% unrealized share loss within the money strike, specifically for WLB, it would take between 12 and 13 months. It's critical that we decide where our cash should be placed. It doesn't matter that we started with WLB or any other stock. It's where should that cash be placed today. We no longer have $18 a share. We now have $9 a share. Where should that money be placed? And if we look at the technical chart that we saw for WLB, the chart is telling us is to move on to a different security. And if we found a security with a bullish price chart, we could take advantage of out-of-the-money calls, which will give us much greater profit potential opportunities. So, Sid, as I said before, welcome to the club. Everybody in the investment community has experienced shares that have gone in the opposite direction from where we anticipated them to go. So the point is, we must act in a non-emotional way to mitigate these losses and to start turning things around. In this particular case here, WLB had a very ugly chart pattern, and it looks like it's time to move on to a different security where we could take advantage of the out-of-the-money strikes. So I wish you well, Sid. Thank you so much for sending in this email. It's such an important topic to discuss. And so I want to again thank you for sending in that question. And of course, I also want to thank everybody out there for taking the time to watch this video. Hope you enjoyed it. And most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.